6 arguments for disinflation. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee, because I'd like to have a look at an article that's putting some arguments that we're heading to a period of disinflation on the table. Now, before we go through this article from Zero Hedge, and here they say 8 reasons, but somewhere else they say 6. Anyway, before we go through this, first we need to talk about inflation, deflation, and disinflation, just to give a bit of an introduction to all 3 of the little terms. So this is the definition of disinflation. So disinflation is a temporary slowing in the pace of price inflation, and is used to describe instances when the inflation rate has reduced marginally over the short term. Disinflation is temporary. Unlike inflation and deflation, which refers to the direction of prices, disinflation refers to the rate of change in the rate of inflation. So it's not about prices going down, necessarily going down during a disinflationary period. It's the increase in prices or the rate of inflation going down. A healthy amount of disinflation is necessary since it prevents the economy from overheating. Well, shouldn't things be disinflating all the time due to technological improvements and governments freeing up business to innovate? Yeah, it's early. I'm still hopeful. The danger that disinflation presents is when the rate of inflation falls near zero, as it did in 2015, raising the specter of deflation. Deflation. Okay, deflation is a general decline in the price of goods and services, typically associated with a contraction in the supply of money and credit in the economy. During deflation, the purchasing power of currency rises over time. So why they're scared of deflation? It just sounds good. It means fantastic, your money will buy more. They're worried that it'll take a hit to the velocity of money. People won't be spending as much. You'll be hoarding onto your money because you're thinking, well, I can buy this doodad now, or I can wait a couple of weeks' time and get 2 of them for the same money. And that's why they're afraid of it. You'd really want stuff to get cheaper over time due to technological innovations, but, you know, deflation is the general decline of the price level of goods and services, usually associated with a contraction in the supply of money. Now, here's a chart showing you inflation. The definition of inflation that I use generally is a decrease in your purchasing power. And one would argue that that is due to, well, the decrease in purchasing power traditionally would be considered the outcome of an increase in the money supply. And the path that the money supply takes in and who reaps the benefit of that initial purchasing power, and then where bubbles are created, that's because of, well, that's explained by the candle effect. Refers to the relative prices resulting from a change in money supply and where that money supply is injected. Where's all the stimmy money going? Everywhere. In the US, guys. Go in the stock markets. You're seeing, one could, you know, those share prices, they're definitely inflating. They're going up in price, in value. If you look at some of the price to earnings ratios, it just seems insane how high some of these companies are, particularly from an Australian perspective. You know, invest in a company and get 0.15% return in dividends. You're just hoping for capital growth, or maybe you're just trying to fight inflation. So here's you've got a period of inflation, then you've got a period of disinflation where prices are still rising, but the inflation rate is going down. And then deflation is when prices are going down, when they're actually going in negative. So these are the 3 things to watch out for. And a lot of people are concerned and worried where it's going to go. Now, I bring these up. These are the traditional definition of inflation, the state of being swelled with wind and flatulence. I'm still a child. The undue expansion or increase from overissue said of currency. These are traditional definitions of inflation. Nothing to do with price rise. The price is the consequence of the inflation because the supply of money is increased. That's that definition. So, 6 arguments for disinflation. Let's have a look at this article here from Zero Hedge. So, expecting inflation to accelerate. Here are 8 reasons to expect decelerating inflation. Because I'm sure there are a lot of people watching the channel who are expecting inflation just to skyrocket. Look at all the money printing that's happening. You know, infinite QE in Australia, infinite QE in the Fed in the US. Stimulus to the moon. So Lacy Hunt of Hosington Management has some interesting thoughts regarding the inflation debate. And here's the US per capita real GDP, 1871 to 2020. There you go. So it's the lowest since 46. So in its quarterly review and outlook for the fiscal quarter of 2021, Lacy Hunt makes a case for decelerating inflation. Contrary to the conventional wisdom, disinflation is more likely than accelerating inflation. Since prices deflated in the second quarter of 2020, the annual inflation rate will move transitorily higher. Once these base effects are exhausted, the cyclical, structural, and monetary conditions suggest that the inflation rate will moderate lower by year-end and will undershoot the Federal Reserve's target of 2%. The inflationary psychosis that has gripped the bond market will fade away in the face of such persistent disinflation. After declining 5.2% in 2020, or the most since World War II, worldwide real per capita GDP is estimated to rise to 4.7% in 2021. The United States will perform even better, rising 6.2% after a contraction of 4.9% in 2020. The US growth rate this year could be the fastest since 1984 and possibly even since 1950. 5 considerations suggest that such growth is not likely to lead to sustained inflation. Lucy said 5. The author has added a 6th bullet point for his discussion, then 2 more of my own points. Okay, so we're getting to 8, guys. We're getting to 8. Number 1, inflation is a lagging indicator, as classified by the National Bureau of Economic Research. The low in inflation occurred after all the past 4 recessions, with an average lag of almost 15 quarters from the end of the recession. So we can table 1 in the thoughts below. 2, productivity rebounds in recoveries, and vigorously so in the aftermath of deep recessions. This pattern in productivity is quite apparent after the deep recessions ended in 49, 58, and 82. Table 2 below. Productivity rebounded an average 4.8% in the year immediately after the end of these 3 recessions, and unit labor costs were unchanged. The rise in productivity held down unit labor costs. 3, restoration of supply chains will be disinflatory. Supply chains were badly disrupted by the pandemic. Low-cost producers in Asia and elsewhere were unable to deliver as much product into the United States and other relatively high-cost countries. This allowed US producers to gain market share. As immunizations increase, supply chains will be gradually restored. See, this is the hope that everyone has. Thus, the pandemic cost, the lower-cost producers' market share was shifted to domestic producers. The pandemic did far more for domestic firms. 4, accelerated technology advancements will lower costs. Another restraint on inflation is the pandemic greatly accelerated the implementation of inventions that were in the pipeline. Necessity is the mother of invention, as has been demonstrated in earlier crises like war. Thus, the technology du jour is not the same as the technology of a year ago. This will also serve to act as a restraint on inflation. Much of the technology substitutes machines for people, communication without travel, and work without offices. It's a very interesting point there. I was talking to a friend, and his wife really preferred the lockdown, particularly with a child who needs additional support or therapy like ours, because they could do all the things on Zoom. People could work remotely, didn't have to travel as much. And it's in some ways, these companies adopted this tech, and some are just quickly abandoning it. I wonder why they're not, saying, "Oh, this is another option that we can provide." You think there would be, wouldn't they? Are they still going to do home workouts remotely with Zoom? Let me know if you've done that, guys. Eye-popping economic growth numbers based on GDP in present circumstances greatly overstate the presumed significance of their results. This is where the fallacy of the broken glass comes into play. Many businesses had failed in the recession of 2020, much more so than normal. As survivors and new firms take over their markets, this will be reflected in GDP, but the cost of the failures will not be deducted. This is interesting. Well, we haven't really seen that in Australia. It hasn't materialized yet with just the number of businesses that are going down. So you'll see, GDP will go crazy, but it really is like employment numbers. They'll talk it up. So many new jobs, but so many of them are simply just returning what was already there. It's not really growth. The two main structural impediments to traditional US and global economic growth are massive debt overhang and deteriorating demographics, both having worsened as a consequence of 2020. So we can see here the sharp economic rebounds and the productivity and unit labor costs. In 49, real GDP per capita was down 2.3%. In 50, it was up 6.9%. And the unit labor costs, negative 0.3, negative 0.7. Look at the productivity increase. 58, down 2.4, up 5.1. Productivity has gone up. Unit labor costs have only gone up 0.3. Same thing in 82, everyone. A recession hit, a decrease in GDP per capita, and it surges back up. Productivity goes up, and unit labor costs average out to nothing. Nothing. Let's have a look at some of the additional comments written by the author. So, Lacy is talking about inflation as measured by the BLS. I'm in 100% agreement with every point. Thus, I expect bond yields to soon peak if they have not done so already. The 1 year-over-year inflation spike is coming. The above viewpoint is not incompatible with my March 12 post. Inflation is poised to soar 3% by June is almost certain. Year-over-year comparisons produce very large numbers, up and down, heading in and out of recessions. I commented it is not that inflation will be rampant, rather it is the impact of year-over-year comparisons goosed by huge COVID-related dips in energy prices in April and May of 2020. I also commented a producer's price index spike is on the way to the top. The rationale is the same, and as noted, gas prices are soaring. I pay $3.28. How much do you pay? Well, we pay a fair bit. So, hello Fed, inflation is rampant and obvious. Why can't you say it is? Well, a lot of people are seeing inflation in their day-to-day lives. I did a poll on my YouTube channel, and you know what? I will bring that up right now. I just asked people about construction costs because I've had some viewers sending me some questions about it. So, is anyone noticing changes in the cost of construction materials? 90% are saying yes, prices are increasing, which is frustrating because I'm about to do a construction project, everyone. It's, 9% are saying they're saying the same, and 1% are saying they're decreasing. B-Tiger, yes, go to Bunnings, and all prices are up a lot. New Zealand broadcast the timber shortage. Here we go. And our supplier says he won't be filling New Zealand store orders. Now there's calls for government intervention. Yep, more of it. Oh boy. Same in Poland, especially for steel. Everyone's saying steel going up. This is my own bias here because I'm putting steel in my house, guys. I've got shit store. We're digging down. Oh, great. I'm heavy in cash right now for this job. I don't want steel to go up. Well, there you go. Maybe I should buy the steel, stick it in my house, and then I might get a better return than other investments. I'll just tear out the steel and sell it in the future. If you aren't already, you need to keep an eye on the futures market where all these basic commodities are hedged and traded. And here we go. Random length lumber contract went from $250 last year to $1,000 USD currently. Lumber, 4x in 12 months. Okay, copper up, corn up, soybeans up, live cattle up. Well, live cattle, we've got the issue with regards to the drought here in Australia. Don't worry, bros, because there's no inflation, nothing to see here. Well, there you go. Steel prices are going way up, and I'm frustrated. Steel prices is up, and not enough stock is coming into the country. I wonder what country that is. Is that Australia, Bill, or somewhere else? Probably Australia. Well, another thing we need to consider, particularly with these costs, is shipping costs. What's imported, that's skyrocketed to the moon too. So, two bonus reasons to expect lower inflation, the bubble pops and higher taxes. Lacy came up with 6 excellent reasons to expect lower inflation. To those, we can easily add 2 more. The bubble pops. The expansion of bubbles is highly inflationary. and popping is the reverse. Please note that the largest increase in margin debt since 2007 fuel stock market. What happened in 2007, we all know. Higher taxes are hugely disinflationary. Look at where we're headed. Well, there you go. Not all of those tax hikes will be passed on, but some will. Biden wants to increase the corporate tax rate to 28% from 21%, looking to compromise at 25 or so. Progressives want huge tax hikes via reconciliation. Some of them will get through. These tax hikes are very recessionary and disinflationary. Recovery in low-paying jobs? Nope. It's been one heck of a recovery in low-paying Zoomer jobs. That's not a big inducement to higher inflations either. Add it all up, there's 8 reasons why. You have 8 reasons to expect inflation will soon peak, and then the argument being that we will enter the period of disinflation. So here's what we'll go back to this chart. Are we about to hit the peak of inflation, then enter a disinflationary period? So guys, what are the solutions? Here's the thing. You're getting mixed messages from all these different people and commentators, and some have, businesses entirely based on a particular agenda. Rampant inflation's coming, hyperinflation's coming. What if we're going to have disinflation? Do you pick a side? Do you become part of the team? Do you hedge all your bets in one? Or do you diversify your information sources and prepare for both? I mean, if we're getting disinflation, are we going to hit deflation eventually? And then how do you hedge? Do you go in gold? Do you go in property? Do you go in silver? Do you go in Bitcoin? What do you reckon, guys? I think the one thing is to diversify your information sources and be prepared. Maybe I better rush out and order that steel. As always, guys, thank you for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can support us using our affiliate links on Amazon, eBay, Independent Reserve, or AussieBroadband. Take care, guys. Have a great day, and I will see you all next time. Bye for now.